Welcome to Volume 5, Issue number 3 of the Milestone Investing newsletter. And this week's ex-dividend date is the 17th of January 2019. We've got 3 companies, SSE, Compass Group, and Ashtead Group. This is going to pay out, this is the dividend it's paying, 29.3p. The share price on Friday, at that time of publication, when I was getting these numbers, that was a share price, 1154p or £11.54. And so when you divide this by this times 100, you get 2.5% dividend yield. But because you can get it with a 5% margin, then this number basically multiplies by 20. There are 5 lots of 20 and 100. And that means this number will multiply by 20. And so 2.5 times 20 becomes 50%. So that's how you get a derivative yield being exaggerated or enhanced because of the fact that you only need to put down a 5% deposit to pick up all of this. Another way of saying the same thing, you're only paying 5% of this price, okay? Only 5% of this. And then you pick up all the dividends based on that, okay? And that's why, again, you get a nice little boost in derivative. So let's go back now. SSE for professionals is 50%. Non-professionals will get a derivative yield of 12% because they have to put down a bigger deposit, 20% here. Compass is delivering for us 1.5% dividend and 20.3% for professionals and 7.6% for non-professionals for Compass. And Ashtead Group is 6.9% or 1.7. Now, one of the rules we have with Milestone Investing is that anything above 20% for professionals, we look at it in more detail. Anything less than that, we can't leave it alone, okay? And again, you can trade it if you want to, but we just don't look at it in more detail. So this week, what's available? The ex-dividend date is the 17th, and SSE are paying out 300 million, Compass is paying out 400 million, and Ashtead is paying out 31 million. So what's available is 730 million pounds. That's what's available for quantification this week. And if you want to know when you get your dividend, here are the dates. SSE will physically pay you a dividend on the 15th of March. You qualify for this week, but the 15th of March, I'll give you a check in the post. Compass will do 25. Well, on the 25th of February, they'll pay you the money. Ashtead will pay you on the 6th of February if you are going for the dividend. If you're going to trade the derivative, you get paid on this day. You trade on the 16th and you get paid on the 17th, one day later. So the derivative, you get paid much, much quicker. Okay. Let's go to SSE. SSE PLC is engaged in producing, distributing, and supplying electricity and gas, as well as other energy-related services to homes and businesses in Great Britain and Ireland. The company's segments include networks, which consist of electricity distribution, electricity transmission, and gas distribution. Retail, which consists of energy supply, enterprise, and energy-related services, and wholesale, which consists of energy portfolio management and electricity generation, gas storage, and gas production. The network segment is engaged in the distribution of electricity to customer premises in the north of Scotland and the south of England. Its retail segment supplies electricity and gas to residential and business customers in the UK and Ireland. The wholesale segment is engaged in the generation of power from renewable and thermal plants in the UK, Ireland and Europe, and the procurement of and optimization of power and gas and other commodity requirements. The CEO is Alistair Phillips Davies, and the Director of Finance is Gregor Alexander. This company is number 37 in FTSE 100, and it has a valuation of 10.5 billion as of January this year. If we were to trade this company for its dividends in the last 7 years, they pay dividends twice a year. So we would have had 14 opportunities to trade this company for its dividends. And in the last 7 years, had you gone wrong, 2 times out of 14, you would have received a dividend and gotten your money back within 7 days. 3 times out of 14, which is 21% of the time, it would have taken you more than 7 days, but less than a month. And to be exact, it was less than 2 weeks on all 3 cases. And 6 times out of 14, which is 43% of the time, it would have taken you more than a month to get your money back. The time, the range was 51 days at the least, and 487 days at the most. And also 3 times out of 14, which is 21% of the time, you wouldn't have got your money back at all. 170 days, 723 days, and 898 days have elapsed since that time in the last 7 years. So out of the 14 times, 11 times you would have gotten your money back based on around the times I just said, and 3 times you didn't get your money back at all had you gone long. If you've gone short, now the way we measure going short, we basically look for because we know it's going to go down quickly and then go back up again, we only count the first 2 days. And so because we go on the Wednesday, we're looking at Thursday and Friday and maybe Monday's performance, and that's it. And so in this analysis, I'm only looking at the first 2 days, which is Thursday and Friday. So had you, in the last 7 years, had you shorted this company and took advantage of the drop, 9 times out of 14, which is 64% of the time, you would have made money on day 1, which is the Thursday, by shorting it. And your return on investment was anywhere between 7% and 27%. Had you, on day 2, you would have had 8 opportunities out of 14 to make money, and that is 57% of the time, 57. And the return on investment on day 2 was between 5% and 32%. So that's SSC's performance. Okay. In terms of their fundamentals, this is where we look at basically how they're doing in terms of why they're making money, basically. What's going on here? So this is basically the blue looks at the revenues, the money, their sales or their revenues, income. And then the little brown boxes or orange boxes look at their profits. Okay. And so all of these numbers are in millions. And so this basically becomes 30.5 or 30.6 billion. So in 2014, they made 30.6 billion. Then it went up to 31.7 billion. I'm rounding it. And then in 2016, it dropped to 28.8 billion. It went up again to 29 billion and up again to 31.2 billion. And so basically there was a drop in 2016. They had obviously a horrible year 2016. And then basically they're back up to where they normally would be. So they're kind of getting healthy again. Their profits. In 2014, they made £593 million. 2015, they had 735 million. It dropped back down again to 593 million and back up again to 1.8 billion and then down a little bit to 1 billion. And as a performance measure, if you look at the line that says profit margin, we can see that for every £100 made, £1.90 dropped down to profit, 1.9%. For every £100 made, they had in revenue, £2.30 dropped down to profit, 2.3%, and so on and so forth. So you got 1.9, 2.3, 2.1, and then it went to a whopping 6.1 for them. Not for everybody else, but for them it's quite big, and then 3.5. So we can see that in this range, up until 26, 2% was kind of where they're at, and now they've kind of increased on that. Now, what that basically means is that they are cutting costs relative to their revenue generated. Okay, and if we look at, for example, this one, this is 31 billion. That's 31 billion. So it's in the same ballpark, but yet they managed to generate 1 billion profit here, as opposed to 700 million. So they're basically just saving £300 million in costs, and that's obviously dropping down. And that becomes money available to shareholders, which is what we are interested in, because we're shareholders. What else can I tell you here? Let me look at the P ratio. The P ratio is the price of the shares compared to the earnings of the shares. And so in 2018, we have the price is 15 times the earnings. Okay. Now, if you take 100 and divide it by 15, you get 6.55. So that's almost equivalent to maybe like 6%. Let's say 6%. is what they're generating for you, okay? That's how I'd like to look at that. Here, you've got a P ratio of 10. So the earnings, the price is 10 times the earnings, which is technically like a 10% return to you. Here, the price was 30 times earnings, 3% return to you. 28 times earnings, 3% return to you. 43 times earnings, 2% return to you. The bigger this number is, the bigger the number on the P ratio, the more expensive the company is, okay, relative to what it's generating in profits for its investors. If it's too large a number here, you might argue it's not worth it, okay? And if it's a reasonable number, you might think it's a it's value for money. If it's too cheap, like let's say the P ratio was 3, which basically means that you're getting 33% return on your investment, that is something wrong with the company. If they literally giving you that much return on investment, there's something wrong. So you don't want it to be too small, but you don't want it to be too big either, okay? That's SSE. Let me summarize what I've just said. If we look at SSE, we can see that they have a better track record of rewarding short traders in the last 7 years than long traders, okay? Compass, on the other hand, has a better track record of rewarding long traders than short traders in the last 8 years. It's really 8.5 years, but 8 years, okay? Compass. The one that we didn't talk about, Ashtead Group, because again, the returns were quite small, but nonetheless, they have a better track record of rewarding long traders than short traders, okay? So that's the performance of the companies this week. So if you want to go short, you might want to look here, where it's highlighted. And if you want to go long this week, you might want to look here, okay? Hi, this is Miles from Milestone Investing. And I just want to give you some feedback on SSE PLC. On the 16th of January, 2019, this is where the share price was the day before ex-dividend date. So ex-dividend date is here. And this is the last day for qualification for the dividend would have been the 16th of January, 2019. So we can see the share prices between the red line, lowest price on the Wednesday, and the green line, the highest price on the Wednesday. So if you are a short trader, you're going to be trading to take advantage of the drop. If you are a long trader, you're going to take advantage of receiving a dividend and then getting your money back. Now, a lot of people say to me, but why would you want your money back? You want to profit on the money. You don't want your money back. Well, because you picked up a dividend. The dividend is your profit. And when you get your money back, you walk away with a dividend. So this is the play with dividend fishing. Okay, so let's look at this one. SSE, what does it do? Well, it gaps down and it drops essentially to just above the dividend adjustment point. And then it falls to the milescope adjustment right here. So this is a milescope adjustment, and we kind of, our students know this and our subscribers know that this is where it's going to fall to. What does it do? It follows the script. It literally uses the milescope adjustment as a support. And it literally walks on this area like it's water. It goes up a little bit, it walks on it again, and it continues along the milescope adjustment. And then it goes up to the dividend adjustment, okay? And then it hugs along that one. So here's the bottom line. Tell me right now. The dividend adjustment, for fundamental reasons, it goes to the dividend adjustment. And for technical reason, it goes to the milescope adjustment. These are two different formulas, and this is where it's going to. So what does it do? On day one, it drops down to the milescope adjustment and then settles back around the dividend adjustment, okay? This is what SSE does. So then the next question then, well, how long did it take to go back up again so that long traders got their money? So we can see the short traders got paid first. So what about the long traders? If I just zoom out a little bit and just get this in to kind of move along, let's see when they got them out. There we go. So we can see here, this was your ex-dividend date, and it goes above the green line. The share price goes above the green line. So anyone who received a dividend got their money back on the 30th of January. You're in the trade on the 16th of January, you got your money back on the 30th of January. So you had to wait 14 days. And 14 days is 2 weeks. So 2 weeks to get your money back. So, okay, so what was the return on investment? Well, SSE for professionals was delivering a 2.5% dividend yield or a 50.8% derivative yield. And for non-professionals, it would have been 2.5% dividend yield or a 12.7% derivative yield. So professionals made 50% return on investment and they got their initial capital back the very next fortnight. What does that mean? It means if you wait a little bit longer, you got a capital gain profit if it went above. But the bottom line is this: you can do it again. You made 50%, so you could do it again. Another strategy, you could have shorted this company. Once it hits the milestone adjustment and you see that it's basically not going anywhere, you can just go long. And if you go long, you make the money going down, you make the money going up. This is the key to the dividend fishing strategy. So in the case of SSE, it took 2 weeks to complete the cycle, drop and rise. 2 weeks. So you made money here, you made money here. I hope that was helpful. This is Miles from Milestone Investing. Happy trading.